if we're heading into a recession, you got to ask yourself, what do people need to survive? I review portfolios, and when I look at a lot of the portfolios I get, probably 80% of them are like these junior mining companies. And when I kind of ask some questions on, I haven't heard of this company. What do you like about it? Oh, I heard it and Doug Casey mentioned it. And that was 6 months ago. I think that 80% of the portfolio should be, for most people, should be in things like the Sprott Physical Uranium Trust, PHYS, the Sprott Physical Gold Trust.
Hey guys, welcome to Capital Cause, and today I have a very special guest. It is Steve Barton from In It to Win It. Steve, thank you for coming on, my friend.
Yes, Danny, thank you for having me.
Yeah, well, thank you for having me earlier today as well. I enjoy your channel. You cover a lot of the same guests that I have on the channel here. So if you don't already, please be sure to follow In It to Win It. We'll have the link to that YouTube channel down below. But as always, guys, nothing in this video is financial advice. Neither Steve nor I are financial advisors. So please do your own due diligence there. With that said, Steve, give the audience a bit of a background on who you are. What got you into investing, and what got you into creating a YouTube channel, interviewing experts the likes of Rick Rule, Justin Yoon, and more?
Yeah, I've always been fascinated by games and gambling. And I remember as a young kid playing penny ante poker, and I was like, wow, this is amazing. I can play a game here and make money at it. And so that led into a semi-professional poker career for over a decade. And what got me into stocks and investing, I've always been in charge of my own retirement, but when the COVID crash hit and everything just tanked, I went all to cash. And I basically realized, okay, there's something about this 60-40 portfolio that isn't working right now, and I need to understand this and figure out what it is. And so I went all into cash. I had already been doing some options trading at that point, so I knew how to rudimentary read the charts. But we got back in and got out a little bit too soon, but hindsight's 2020. And that I used to have a poker podcast, and that translated into an investing podcast that we have today. And I just started interviewing guys like you have done, Doomberg, Peter Granich, Rick Rule, Justin Yoon. And I realized that I think over this next cycle, meaning the next 5 to 10 years, it's going to be a commodity driven cycle, not necessarily a 60-40 one. So yeah, that's what we do. We study the commodities market almost exclusively. That's almost entirely where we have our portfolio. Whereas only a few years prior, I think it made up 15% of the portfolio. So we've really narrowed it down. That's what we study. We pick the guest's brain, and then we do our own research, and that's where we place our bets.
Yeah. So are you now all in on commodities? Are you 100% allocated in commodities?
Yeah, I mean, with the exception, we've got about 20% of the portfolio in cash in the form of 1 month rolling treasuries. So every week we have a treasury that comes due, and we can either choose to roll that over or we can invest it into the commodities market. But I really like having about a fifth of the portfolio just making us 5.4%. Because I think we may be approaching a big correction in the market. If the S&P crashes, our uranium equities are very likely going to go down with it. And I want the opportunity to be able to buy more.
Yeah. Yeah. So let's get into why you got into commodities. What is so special about commodities that you're willing to go in as much as you have already?
Yeah. So I started out in my rudimentary portfolio before I had a better grasp of what was going on. I just went by the Ray Dalio all-weather portfolio, which was 40% long-term bonds, 15% intermediate bonds, 30% S&P 500, 7.5% gold, 7.5% commodities. And that's when I realized that 15% of the gold in the commodities portfolio was doing extremely well, and everything else was just going into the toilet. And so that got me down the road of okay, we're going through some pretty radical inflation, which we're going to have some ebbs and flows here, but I think over the course of time, this is going to look a lot like the 1970s. And if that's the case, and you go back and look at history, commodities do extremely well. If the dollar gets weaker through inflation, it takes more of those dollars to buy the same good and service, whether that's a barrel of oil, an ounce of gold, or a bar of silver. So I think those are the things that we need to be invested in. If we're heading into a recession, you got to ask yourself, what do people need to survive? Okay, they need food, they need water, and they need electricity and energy. Without electricity, people die, right? Without food and water, people die. Those are the things that I think will do well during an inflationary environment, during a recession, during economic hardship. And I think things that are going to not do so well are things like NVIDIA, things like Tesla. Nobody cares about buying an electric vehicle and saving the environment when they lost their job and they can't put food on the table. So that's kind of our base case for investing in commodities. And so far, it's been working out really well.
Yeah, I mean, they've already started slashing EV production for manufacturers like Mercedes and I believe some more as well. Hertz has actually been liquidating their EV fleet too. So there's a lot of truth in what you say.
Yeah. I see the same thing. I think that EVs were a narrative more than they were a reality.
Gotcha. So walk us through your investment philosophy here, Steve. Like, how do you allocate capital to various sectors? How do you determine opportunities? Walk us through how you structure your portfolio.
Okay. Yeah. So basically, we study. I think it's a base case. If you believe that the monetary system is, going to continue to inflate away, I think you need to protect yourself first and foremost with some physical precious metals, and that means, holding it in a secure vault somewhere like Brinks. Maybe 5 to 10%, depending on the person. After that, I really like putting them into some of the equities. So you can do the same kind of thing with that gold portion of the portfolio. You can have it in a fund like PHYS, the Sprott Physical Gold Trust. That's a very liquid way to be invested in gold that, you still hold the, I'm doing air quotes, physical commodity. After that, you could do something in physical silver. Then we can leverage a little bit. We can start betting on some of these major miners, and they are extremely leveraged to the gold price. So let's say the gold price today is 2,000 and it goes up to 2,100. Well, if this miner is able to pull it out of the ground profitably, all in sustaining costs at 1,900, so they're making $100 an ounce, right? Well, if it goes up to 2,100, now they're making $200 an ounce instead of 100. They just doubled their revenue, but the gold price only went up by $100. So if you're holding the physical metal, you made $100. If you're holding that miner, you doubled your profits. So I like that a lot. It really depends on the investor. I like the oil sector a lot. I don't think there's as much upside, but these companies are swimming in cash. They are doing amazing dividends. They're buying back shares. And everyone hates oil. Everyone, the mainstream thinks that we're still going to go to these EVs, which, we think is a farce, just like we said. So I like the oil sector a lot. I also like uranium a lot. I think uranium was a little bit 2023, but I've recently heard an argument by Lobo Tigre that, he's on your channel. And he was saying that uranium may be 2024 as well. And a big part of that is the two 800-pound gorillas in the room, Cameco and Kazatomprom, are actually going to be producing less than they thought. So if you have the two biggest uranium miners on the planet that are pulling less of it out of the ground, that's very good for the supply-demand dynamics if you're holding uranium, right? So we like uranium a lot. I think there's a real argument for coal. It's also hated. Yet the world consistently is using more and more coal as time goes on, despite what our big thinkers would like us to believe that we're moving away from it. India has to come up the same way we did. You know what I mean? China's got to come up the same way we did, and they're doing that by burning coal for their power plants. And I like that bet a lot. What are some other bets I like? I like silver. I think that silver's probably got a little bit more time. I think we'll see gold move first. If you look back over history, usually gold moves first, and then after that, silver moves, but it does so parabolically. So I think there's a real argument for silver there. And then copper. I also like copper. I think that copper should do well over the next 5 to 10 years. I think we're probably going to take a pretty big hit in copper in this coming recession. But when you look at the macro picture, most of the copper mines are old and aging. And, a mine is finite. You can only pull so much of the stuff out of the ground before it just isn't there anymore. And I think copper will do well. And then a real speculative one that I like, although we don't have much of the portfolio in it, I think it's probably only about 2%, maybe 3%, is platinum and palladium. Man, when you compare those and you cross-reference them onto, how many ounces of gold does it take to buy 1 ounce of platinum or palladium, or vice versa, we are at extremes on those charts. And I think it's only a matter of time before those reverse. What we need a hiccup in either Russia, South Africa, or Zimbabwe, where most of our platinum and palladium comes from. If there's a hiccup or one of our big thinkers decides to throw a sanction on one of those, I think that'll go parabolic. I don't know how you'd catch that the day before. I think you just got to be invested beforehand and wait for that day to come. But those are our general commodities that we follow. And as far as a percentage allocation, it really depends on, where you are in your life and what your risk tolerance is.
Yeah. So are you more of a long-term investor, or do you try to swing trade these things?
Mostly long-term, although I do take about 8 to 10% of the account, and I use those for short-term swing trades. We got a option in right now on wheat and precious metals, which is doing amazing. In 3 days, it's up 130%. So I'm probably going to pull that right after this interview. We got a swing trade in on silver through the SILJ ETF. That's up a little bit. I think I'm going to let that run a little bit. If silver can get through the 200 daily moving average, I think it's got some more upside. So I may leave that one on a little bit. But yeah, only about 10% of the portfolio we allocate to these. I think it's more to keep our monkey brain busy than it is anything else, but I really like it a lot. It's a lot of fun. So 90% of it is long-term. Being in America, there are tax advantages for holding these positions over a year. And so most of the time when we buy, we fully plan on holding it for over a year, unless something in the fundamental narrative, fails, then we'll get out. But for most of it, it's long-term.
Yeah. So how do you identify when it's time to buy versus when it's time to sell? How do you identify opportunity versus, let's say, when something's run its course? Where do you look at any specific metrics? Are you more of a TA guy? Are you more of a fundamental analysis guy? Or are you more of a hybrid?
I suppose kind of a hybrid. I'm going to share my screen here. And basically what we're looking at here is, let me get this one off the charts so we can see it a little bit better. So this is the S&P 500. I look at fundamentals as a way to kind of understand what to buy. Like we were talking about with oil, if they're buying back shares and paying amazing dividends along the way and everyone hates them, then I think that's a pretty good reason to be in oil. And then I use the technicals here to know when to buy that commodity and when to sell it. And so, for example, here's the S&P 500. The indicators we look at are these moving averages. The ones we like are the 10, 20, 50, 200, and 400. And then here's the RSI, MACD, and stochastic. And just kind of a easy way to read this here is whenever the RSI and the MACD and the stochastic are up at this range up top, that's generally a time to sell. And whenever they're down here, if we line this up and you follow it up to the charts, you can see that would have been a really nice time to buy, like if you're doing some kind of swing trade or something for maybe over a year, and that would be a really nice time to sell. So this is on the monthly chart. Here's on the weekly. All these indicators are just completely in the clouds. Here's the daily. I mean, that's what we do. That's how we identify the time to buy and to sell. And we did the same thing with uranium, and we'll do the same thing with the other commodities. Yeah, that's basically what I look at. Those are the indicators.
Gotcha. So you had a chart pulled up there. I believe it was gold versus the Fed funds rate. Walk us through the relationship there.
Okay, so here's the chart right here. The bar chart here is gold, and then this orange line that you see is the Fed funds rate. So what our big thinkers decide interest rates should be. And if we go back 25 years, I tried to find a pattern going back here to like the 1970s. And I think the Fed was just too much of the Wizard of Oz behind the curtain, just pulling the levers real quick on interest rates. I couldn't find a discernible pattern. But once they've stopped doing that, and we look at these last 4 hiking cycles. So this one is going back to the turn of the century, 99. The Fed hiked rates, then they paused, and then they cut rates in the face of the dot-com bubble. And if we track right here when they started cutting rates, and we correlate that to the gold price, so we line this up here, we take the gold price, and we see what this moves at. So they cut rates, and then they paused. And, right here it says 80%. Now, initially, gold moved down a little bit. I think the same thing's probably going to happen during this next crisis, is gold may go down. Anything that gets that has a bid gets sold, and gold always has a bid. So I think that'll get sold as well. But look at that move right there, right? Now we do the next one. Here's the next hiking cycle starting in 04 and then ending in 06. And then they pause, and then GFC, Great Financial Crisis. And we can see right here, we'll run the same move. So when they start cutting, and then when they had a nice move up here, like 50, 60%. And then right here in November, they introduced something new called QE, quantitative easing, because when they put it in terms like that, your average person has no idea what they're talking about. But basically it means that they just started printing money, and having more dollars in existence makes each one of those dollars less valuable. So it takes more of those dollars to buy the same ounce of gold. And we get a run here from 2008 to 2011 of almost 200%. Okay, so that's the second hiking cycle and cutting cycle. Then it basically goes sideways here for a while, and gold, the Fed starts increasing interest rates, and then right here is when they start to cut. We'll run this again, and from right there, from when they start cutting, we go up 60% again. Now, here's today. The Fed hiked interest rates at the fastest time in their over 100-year history, and we've been paused at 5.33% here for months. I think when the Fed, and the Vegas odds have them doing it around July right now, I think when the Fed starts to cut rates here, we're going to have a repeat of what we had before. And as far as, what is that going to look like in the terms of price, the way I like to run this is this gold has had an enormous cup and handle pattern going back to 2011. I mean, if you just run, just kind of basic TA, here's the cup, here's the handle. And typically when you get a pattern like that, which we've had previously in gold, you'll get a move. You basically take the bottom of the cup here to the top. That's a move of about $1,000. I fully expect that it's going to move up about another 1,000 as well, which will bring us around 3,000. Time frame on that, I don't know, a couple of years. My best guess for the end of the year, and just a complete guess, is that by the end of 2024, I think we'll be around $2,300, $2,400 gold. Maybe it'll be higher. I don't know, but I like this bet a lot. I think that this is probably our number one pick for 2024.
Gold, number one pick.
I think so. Yeah. The caveat with that is recently with the news on Cameco and Kazatomprom, it could be uranium. We might be eating our own words here, but those are definitely our top two. But I think gold. We'll see. Time will tell.
Gotcha. Tell us what's been going on with uranium lately. We're down to $94. What's your view on uranium?
Okay, following the smart people on Twitter like Justin Hune and John Quakes, I think this is a pretty good, this is looking at the monthly chart on uranium spot price right here. And I think this is simply traders taking profits at the, this is the beginning of March here. I think that we're going to start getting some more buying pressure here coming in March. Talking with Justin Hune, term contracts. So there's spot contracts, which is any uranium bought in 12 months or less. And then there's term contracting, which is they're basically signing contracts out into the future, 12, longer than a year. And he said that the last contracts that went through for 3 to 5 years out are signing around $107 to $113 a pound.
Hey guys, quick pause. I won't take too much of your time, but I just wanted to let you know that if you want to use and read the same newsletter that I do, Capitalist Exploits, we have a special $1,000 discount exclusively for Capital Cosm viewers of this channel. You simply have to click on the link down below, get your $1,000 discount. Super stoked about this. I discovered Chris and Brad's newsletter, Capitalist Exploits, 4 years ago. It set me on my investment journey. I attribute a ton of what I know to that newsletter. So if you haven't already, check them out. Click the link down below to learn more. Take advantage of this $1,000 discount. You're not going to find it anywhere else. All right, now let's get back to the video.
We're sitting at 94 according to UX. And yeah, I think this, generally speaking, is going to be moving up. And, Lobo brought something up on your channel that makes a lot of sense to me, is that this, I think, is going to be recession proof. And it's because the utilities don't care what the price is. They just have to buy uranium. If they have to shut down their nuclear power plant, this is a huge endeavor. Cities go without power. They want to keep these things running and keep the base load power going. So they don't care if uranium is $94 a pound or if it's 150, they just have to have it. So although I don't think that our uranium equities are impervious to inflation, I think that the Sprott Physical Uranium Trust is. And I think that this is a really easy way to track the spot price of uranium and to bet on it. And as we're recording now, I mean, we have an amazing setup right here in the Sprott Physical Uranium Trust. I mean, you can buy $23 worth of uranium and it only costs you $20. And so right now it's trading at a 13% discount. We almost caught it yesterday. This was down around 1975. And then I took a phone call from my buddy and I looked back and it was over 20. I'm like, dang it, I missed it. But I like this fund a lot. I think this is a very easy beta way to play uranium. And basically all we've been doing, it's not super scientific, is when this discount gets above 12, we buy. And then when it goes to a premium and Sprott starts buying pounds off the market, we sell it. That's about it. You know what I mean? It's not super scientific, but it's extremely effective.
Gotcha. So how do you play the uranium trade? Do you own like a variety of different stocks, developers, producers, explorers? What's kind of your philosophy there?
Okay, yeah. So basically what we did was about 55% of the bet was the Sprott Physical Uranium Trust and URNM. Okay, so that was half of it right there. And then the other half was Rick Rule did a boot camp called the Uranium Boot Camp 2 years ago when everyone hated uranium and no one loved it. And we bought some of the uranium juniors in that boot camp. And that's pretty much it. That's basically the gist of it is we're kind of in the more camp of like, if you just play the ETFs, if you play the safe bet, so for like oil, if you play Exxon, if you play Chevron, if you play an ETF that holds those two big companies, you're probably going to do pretty well. And the same thing with uranium, and so far that's holding true. Our favorite one here is UEC, and the only reason that we got into this one as heavily as we did was because we thought that there was going to be a premium, and also Rick Rule and Justin Hune thought that there would be a premium, so that made our conviction a lot more that there would be a premium on American uranium. And if these sanctions go through with Russia, then you're probably going to have American companies do better than companies outside the U.S. And so far, that's holding true. So that's basically what we do. More than half the bet is on those two, URNM and SPUT, the Sprott Physical Uranium Trust, and then the rest we have filtered through the juniors.
Talk to us about coal. What's your thoughts on coal at the moment?
Coal. Okay, so fundamentally, coal is we're burning more of it every year, and we are we're consuming more of it as a planet. And as much as our big thinkers would like us to believe that we're going to use less coal, the reality is we're not. We're going to use more of it. And so these companies, I think, are possibly even in a better position than the oil companies, and that they're taking a bath in cash and they're buying back their shares at a record rate. So here's thermal coal. So this type of coal is used for power generation in power plants. And then here is metallurgical coal, and that is, oh, why isn't that coming up? That just happened. Well, we'll stick to thermal for now. And so basically, we think we had a coal expert on the show. His name was Matt Warder. This guy's probably forgotten more about coal than we'll ever know. But he believes that, there's what's the word? Seasonality to coal. And typically thermal coal, he said, you want to start paying attention and probably start adding to your positions around March, April, May. So we put our idiot-proof arrow in there around there. And he said it should be around 120 to 130. Well, it's around there now. I suppose we could make entry points, but we'll find technical spots on the chart to do that. And then let's see if met coal comes up. There we go. And met coal, he said, typically the seasonality is probably going to hit a low around June or so. So that's probably about the time that we'll start entering into the coal trade. I think the main way that we're going to play this is treat it just like we did oil and just like we did uranium. And they now have a coal ETF, which has not happened in 3 years. And they have a coal ETF that actually Matt Warder helped allocate and put together, which is pretty cool. We're going to wait until March, April, May, June, around when he suggested that coal is going to have a seasonality move. I think by then this ETF will have enough volume in it. It'll have enough people buying into it or not. And we'll have a lot more information. We'll have more information on the technicals here as far as when an entry is. Maybe this will end up forming a pattern, kind of like URJ did in its infancy, and it just formed like a cup like that, and then we ended up getting a little handle. I have no idea. We'll know more as that comes in. Another play that we're making is Glencore. We like this one a lot. We got turned on to this one through Rick, and they were paying pretty good dividends, but they just made a big acquisition for coal from Teck. It's going to take them about a year and a half or so to pay off that that purchase, and you're going to take it in the form of not getting as high dividends. I think the dividends now are going to be like 1.5 or maybe even south of that. However, after that year and a half, that project is paid for itself. It starts cash flowing. I think this will do very well. We like Glencore a lot. Some other companies that you could get into, ARLP. You could get into Peabody. You could do Whitehaven. You could do Warrior Met Coal. You could do Yan Coal. And this is the one that's gotten the most traction here is AMR, Alpha Metallurgical Resources. Matt was, let's undo that. Matt was saying that he thought, kind of the same thing, let's start paying attention to this thing around April or so. It's probably going to trade in this range somewhere of 375 up to maybe a little north of 400 when we had him on the show back here. So far it's done that. We had a hot minute right here where it bounced up. He said he placed a limit order down here around 360 or so. But I think we basically, if you want to play this one, kind of buy down on this end of the chart, maybe make your real positions once it gets up around April, May or so. And he thinks the next level up is going to be 450 to 475. So yeah, I only got into the coal sector a little while ago. Don't really have any bets other than Glencore, just kind of waiting on what he recommended would be a decent timing.
It's interesting you point out the new coal ETF. There was a prior coal ETF that went offline right before the coal bull market.
Yeah.
Like it's called KOL. They
Yes.
took it offline in the winter of 20. I remember because I held shares in that ETF. They took it offline in the winter of 2020. You know what happened in 2021, 2022? Coal
It
took
went
off like a
parabolic.
rocket. Yeah. So that's your sign. Typically, when ETFs go offline, is your sign of a bottom. I hope this isn't a sign of a top with this new ETF.
I hope not. I hope not. Time will tell. We just don't really have the volume here. I mean, what's the share price? $23. And if I hover over these, you can look right up here and see what the volume is. So far today, 1.6 thousand, volume. So just not much volume at all. We want to see significant volume coming into this. We want to see some kind of pattern forming. And I think with our show, we have a lot of people that have lives. They're plumbers, they're teachers, and I think the ETFs are a really easy way to play it, and pretty low risk. They can put limit orders in on these things and go fishing and go on vacation, and when they come back, they go, oh, it hit. Okay, well now you've got it for a year or more, and then you decide when you're ready to sell it. It's an easy way to play it. You're not exposed like if you have everything in Exxon and they have some giant oil leak out off the coast or something like that, that stock gets hit. If it's in an ETF, then you just have a small percentage hit instead of a big one. I'm really excited for this ETF. I think this will do well. We just want to wait for it to iron out, make sure we get the volume in there and that people actually accept it. And then we'll find some pattern on the charts to make an entry.
Yeah, 100%. You also mentioned oil. You're not too bullish on oil. Go through what you're looking at with oil there.
Okay, here's the oil, crude oil futures. I am bullish on oil, although I just don't think it will do as well as gold.
Uranium. Yeah, gold.
Yeah, or uranium. But I do like it a lot. Okay, so we'll start out here on the monthly. And we can see that it's holding. So this purple line here is the 200 moving average, which is what a lot of traders look at. And it's holding above the 200 moving average. We look at the weekly here. It's holding above the 200 weekly average. We look at the daily. Okay, it just bounced above the 200 and now the 400 on the daily. I mean, this is a pretty bullish looking chart. And we like oil a lot. For your average retail investor, I think a fund like this, like XLE, it's just an ETF. Their biggest holding is Exxon, the best oil producer on the planet, right? That makes up like 20-something% of the portfolio. The next one is Chevron, which makes up, last I checked, I think it was 17%. So your two best oil companies on the planet make up most of this ETF, and then it just goes down the list. Occidental, fill in the blank, ConocoPhillips. We like this one a lot for, just average retail, just, buy on pullbacks. So when the technicals get sold off, and we got low stochastic, low MACD, low RSI, those are when you place your biggest bets. And now it's, we'll just iron this thing out. It just pays consistent dividends, like clockwork every 3 months. And then our favorite holding in oil is XOM, ExxonMobil. These guys are buying back shares. They're paying consistent dividends, going up every time. We like this one a lot. Here's Chevron. We missed this one down here. I mean, it was just boring, just right around $140 for a while. Probably should have gone in, but every one of these companies you see, we study about an hour a month. So I just didn't want to add another one to the list when I don't have time to actively study it. Our favorite oil bet is probably this one. And although it's not going to have much upside, when we look at their dividends here, I mean, this is absolutely incredible. Okay, so this is going back to 2017. 6.6%, 8.6%, 11.7, 10.1, 7.7, 9.1, 11.9% dividends for 2023. I mean, this is an oil royalty play, big market cap, over 3 billion. And basically what they do is they have royalties. I'm sure your viewers are familiar with royalty plays. This is one of the best oil royalty plays in North America, possibly on the planet. I mean, this thing could go sideways and you make money. So we have about 10% of the oil portfolio just in this, not really expecting any upside. But, if you're a retired guy and you're living off the dividends from your portfolio, kind of tough to ignore 10%. That's a really, really good return in in a sector that is likely going to do very well over the next decade. If you believe that you're going to go out to your car tomorrow and it's going to start because we still have gasoline and we're not all driving EVs, then I like this bet a lot. It's we had a stink bid hit down here where we increased the position by about a third. I like this company a lot as far as oil.
Fantastic. Blackstone Minerals. Okay.
Yeah. If you're in Canada, the one you're going to want is Freehold.
Gotcha. So let's go ahead and shift over to, I want to ask you, do you mind unsharing your screen real quick?
Oh, yeah.
So I want to ask you, you interview all these experts. Now that you what are some of the most important things you've learned from interviewing the likes of Rick Rule, Justin Hune? I saw you had Chris Vermillion on the other day. What's your general takeaway from having interviewed these experts?
I suppose our general takeaway is that don't get too caught into like one thesis, and don't get caught in an echo chamber. I like having a lot of different people on the show. Maybe some people think that gold will do well, others will think that gold won't do well. I like to interview people that study this even more than I do. You know what I mean? Really be humble and accept that you could be wrong. And if you are, adjust your portfolio accordingly, But I think our general takeaway is just try to find the best guests possible that study this way more than we do. And, follow their guidance. That's part of our mission statement. We interview some of the smartest minds in the business and we follow their guidance. And I think that's what it is stay humble. You could be wrong. You may be right. But kind of whatever they say, use that as your base case and really be tenacious in studying these things. If you I review portfolios, and when I look at a lot of the portfolios I get, probably 80% of them are like these junior mining companies. And when I kind of ask some questions on, I haven't heard of this company. What do you like about it? Oh, I heard it and Doug Casey mentioned it. And that was 6 months ago. And they, you know what I mean? I think that 80% of the portfolio should be, for most people, should be in things like the Sprott Physical Uranium Trust, PHYS, the Sprott Physical Gold Trust, and if you really don't have the time to dedicate and to study these companies, simply buying the GDX and then go golfing for 2 years is probably the thing to do. If you understand the general sector, okay, I understand why gold is probably going to move up over the next few years. Just buying an ETF or, maybe the best gold miner on the planet would be the way to play that, and leave the 20 or 10 or 5% or zero for those explorers and developers, because they'll do a press release and the stock will jump or fall by 20% in 30 minutes. And these are computer algorithms finding this and then executing. There's no way you're going to be able to compete with that. You really have to study, these companies in this sector if you're going to play that leveraged gain.
Yeah. Yeah. So those are some of the biggest mistakes you also see with people, with other investors. Right. Okay. So I think it's a pretty good place to end things on. Any concluding thoughts there, Steve? Where can people find you?
Yeah, if you could do us a favor and just put a link to our YouTube channel in the comment below. We love interviewing guests like this. We probably put out an episode anywhere from 2 to 3 times a week. And every Sunday we do a show called Monday Market Moves. So we bring up all the commodities that you just saw on our watch list there. Any companies that listeners want to see us pull up on the charts, we'll pull it up. We'll maybe bring up some fundamentals, but if I'm not familiar with the company, I don't comment on that. I just look at the charts and try to find some entry points. And we have a lot of fun. Love doing this. Have no end in sight. I think this commodities bull run is going to be absolutely amazing, just like uranium was back last year. I think we got a lot of upside potential, and I'm super excited for this sector.
Yeah, this is really fun. Thanks, Steve, for coming on. Really enjoyed this interview. If you enjoyed this interview, be sure to give us a like, comment down below. Let me know what you think. Do you agree or disagree with any of Steve's takes here? Be sure to follow Steve on In It to Win It. We'll have the links down below. Follow him on Twitter as well. And with that said, you guys, I will see you in the next episode. Bye, y'all.